You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive.
Great to be here.
We're jumping straight in today, really digging into the insights from material you shared with us.
Yeah, this time it's a script from All Things Investing.
Right, and we're focusing on the big market lessons from 2024.
Exactly. This isn't, just looking back. It's about figuring out what those moves mean for you, for your investments going forward. The actionable stuff.
Okay.
And your material identified, I think, 8 key lessons. Really stood out.
8 major lessons. All right. So we'll be touching on the AI craze, the return of picking individual stocks, global events.
All the biggies.
Basically trying to give you a quick, thorough grasp of the important takeaways from 24 and maybe how they shape your thinking now.
Sounds good.
Okay, let's get into it. Lesson 1, AI. That whole euphoria meeting. Economic reality.
Yeah, the AI narrative shifted so fast in 2024, didn't it?
It really did.
At first, it was just, pure excitement. Any stock that even whispered AI seemed to surge.
Oh, yeah. NVIDIA was the poster child, like your source said, just stratospheric heights.
Absolutely. Couldn't miss it. But, as usually happens, the market started asking tougher questions.
Right. It went from, are they using AI to something more like...
Okay, how does this actually help the bottom line?
Yep.
And when do we see that cash?
Exactly. And that's the lesson, isn't it? Hype is one thing, but...
But it needs solid financials underneath. Even game-changing tech like AI, it goes through these hype cycles. It's pretty normal, actually.
The market reminded us of that. I liked the anecdote in your source from the portfolio manager.
Oh, yeah, the one about the best AI plays.
Yeah, not always the obvious ones, but the companies quietly using AI to, get more efficient, cut costs.
That really nails it. It ties back to that core investing principle. Sustainable competitive advantage.
Right.
That's what drives long-term returns, not just chasing the latest buzzword. It's about finding businesses built to last.
Which actually links nicely to the second lesson, doesn't it? About needing to look under the hood, even with index investing.
It does. Lesson 2, the return of stock picking.
Yeah, for ages, it felt like the mantra was just buy the index. Simple.
Right. Passive was king. But 2024, it kind of threw a curveball. It really highlighted why active management, actually choosing specific stocks, suddenly mattered again.
How so? What did we see?
The dispersion, the difference in performance within sectors was just huge. Your source used tech as a great example.
Okay.
The QQQ, the tech ETF, did okay overall. But inside that basket, you had some stocks doubling.
Doubling, wow.
While others in the same tech space lost half their value.
Half. That's incredible divergence. It shows tech isn't just one thing.
Exactly. And that kind of environment, what people call alpha rate.
Meaning opportunity to outperform?
Yeah, exactly. It means there are real chances to beat the market if you or your manager can pick the right names.
So what made the difference for those winners in 2024? Was it just luck?
According to your source, no. It really boiled down to deep fundamental research, understanding the actual businesses.
Not just the sector hype.
Right. The renewable energy example you flagged was perfect.
Oh, yeah, the 2 similar companies.
Seemingly alike, but one locked in long-term contracts, giving it stability.
Okay.
The other relied on volatile spot market prices. And the results.
A huge gap, plus 40% versus Nunagari 25% or something. Massive.
Just shows, doesn't it? Market efficiency isn't always perfect. Diligent homework, that research, it can still uncover real opportunities.
Good takeaway. Okay, let's shift to something that always seems to be driving things. Interest rates.
Yes. Lesson 3, interest rates felt like the main character in the market drama of 2024, didn't they?
Definitely. Every Fed meeting, every hint, the market just hung on every word.
Totally. And the key lesson here wasn't just rates up or down. It was the gap between expectations and reality.
Okay, explain that.
Well, early in 2024, the consensus, what most people expected, was pretty aggressive rate cuts from the Fed.
Right, I remember that. Lots of cuts priced in.
But the actual pace was much slower, more gradual.
And that mismatch caused waves.
Big time. Your source mentioned REITs, real estate investment trusts.
Okay.
They got bid up partly on the hope of lower rates making your yields look better when the cuts didn't come fast enough.
They underperformed. Makes sense.
Yeah. And conversely, things like floating rate debt, which can benefit from higher rates staying higher for longer, actually did relatively well.
So it's about the expectation versus the result.
Exactly. It highlights how forward-looking markets are. Prices move based on what's expected to happen.
Like with earnings season too, right? Sometimes beating a low expectation gets a bigger reaction than just meeting a high one.
Precisely. Same dynamic, the
Yeah.
so-called whisper numbers versus the actual print.
So for you listening, the advice is don't just watch the data. Try to figure out what's already baked into prices.
Right, because opportunities often pop up when the crowd gets too skewed one way or the other, too optimistic or too pessimistic.
Interesting. Okay, let's pivot to those giants, the Magnificent Seven, Lesson 4.
Yeah, the Selective 7, as maybe 2024 showed.
Right. What happened there? They seemed unstoppable for a while.
They did. But 2024 was a sharp reminder that, past performance is no guarantee, even for the biggest names.
So they didn't all keep up the pace.
No, there was a real divergence within that group. Some kept powering ahead, sure, but others faced headwinds, slowing growth, maybe more competition.
It shows even the giants aren't immune.
Definitely not. And it flags a really important risk for investors: over-concentration.
Meaning having too much money tied up in just those few names.
Exactly. Whether you own the stocks directly or indirectly through index funds where they have huge weightings,
Yeah.
2024 really hammered home the need for genuine diversification.
And that means more than just owning lots of stocks, right? Your source mentioned.
Right, it's about variety. Different types of businesses, different sectors, different sizes, small caps, mid caps,
International, too.
international, value stocks. The kinds of things that maybe got overlooked when the Mag 7 were flying so high.
The investors who did well often looked beyond those main headlines then.
Seems so. I love that quote from the fund manager in your material.
Which one?
2024 was the year we remembered that the stock market isn't just 7 companies.
Right.
There are thousands. And some of the best opportunities were hiding in plain sight.
Hiding in plain sight. Good phrase. It's about looking broader. Okay, next lesson, number 5. Geopolitics. Felt like that really mattered last year.
Oh, absolutely. Geopolitics equals market reality. It wasn't just noise.
Moved from the background to the foreground.
Definitely. It had direct, measurable impacts. Your source gave good examples: defense stocks getting a boost from tensions, energy companies dealing with supply chain headaches, tech firms navigating different international rules.
So even if you invest domestically, you can't ignore the global picture.
Not anymore. It's also interconnected. A company based here might rely on suppliers or customers all over the world. So global diversification means understanding those links.
You need to know how events far away might ripple back to your holding.
Exactly. The rare earth metals example was telling.
That's it.
Geopolitical shifts cause massive swings in the value of companies mining or processing those critical materials. Investors who really understood supply chain security, well, they were better prepared.
So lesson 5 is basically pay attention to world events, the political landscape, regulations. It's part of investing now.
Increasingly so. Okay, lesson 6. Inflation. Still hanging around.
Inflation's persistent grip. Yeah, even though the headline numbers got better.
Right, some improvement there.
Hmm.
But your source correctly points out the lingering effects were felt all through 2024 on, how people spend, company profits, what kinds of investments people preferred.
We definitely saw a split, didn't we, between companies that could raise prices and those that couldn't.
Yeah, that concept of pricing power, crucial. Businesses selling essentials, things people have to buy, generally held up better.
Because they could pass on higher costs?
Mostly, yes.
Yeah.
But companies selling discretionary stuff, the nice-to-haves.
They felt the pinch, consumers cutting back.
Exactly, margin pressure. The source used utilities versus discretionary retailers.
Good comparison. Utilities are pretty essential.
Right, and often regulated in ways that let them manage costs. Whereas non-essential retailers faced consumers being much more careful with their money.
So for you, the listener, the takeaway is to focus on quality during inflationary times.
Yes, business quality, strong competitive positions, what Buffett calls economic moats.
Like brand loyalty or unique tech.
Things like that. They help protect profitability. Your source also noted how different assets react.
Oh, right. Real assets like commodities or real estate as potential hedges.
While long-term bonds can get hurt by rising inflation fears.
Makes sense. Okay, moving on. Lesson 7, alternatives. Seeing more interest there.
Definitely. The rise of alternative investments. With the traditional 60-40 stock bond portfolio facing, let's say, challenges.
Because stocks and bonds were sometimes moving together when they shouldn't.
Yeah, correlations got tricky, so investors naturally started looking elsewhere more seriously in 2024.
What kind of elsewhere?
Things like private credit lending outside the banks. REITs continued evolving too, not just offices and malls, but data centers, cell towers.
Infrastructure for the digital age.
Right. And commodities got more focused too, tied into those inflation and supply chain themes we mentioned.
But your source included a warning, right? Alternatives aren't all simple.
Crucial warning. They're not all the same. Often higher fees.
Okay.
Less liquidity meaning harder to sell quickly, and just, frankly, more complex sometimes.
So due diligence is extra important here.
Absolutely critical. You really need to understand the fees, the lockup periods, the underlying risks before jumping in.
Got it. But the potential upside, according to the material, could be income.
Yeah, that was an interesting point. With traditional dividend yields sometimes looking low, some alternatives like certain REITs or BDCs, business development companies, were seen as potential income sources.
Okay, interesting development. That brings us to the last lesson, number 8. And this one's kind of encouraging for individuals.
It is the individual investor advantage, something often overlooked.
What advantages do individuals have over the big institutions?
Well, think about it. You as an individual can be more nimble, quicker decisions.
True.
You don't have to report performance every quarter. You can be patient. You can hold concentrated bets if you really believe in them. And you can focus on the truly long term.
Institutions often can't do all that.
Not as easily. They manage huge sums, face different pressures. The small cap example in your source was great.
The smaller companies doing well but ignored by big funds.
Exactly. A company might be too small for a giant fund to invest a meaningful amount in, even if it's a great business. That creates space for individuals.
Plus, access to information and tools is better now, right? Commission-free trading.
Definitely leveled the playing field in some ways. But, and it's a big, but your source adds the caveat.
These advantages need to be used wisely.
Precisely. It requires patience, discipline, focusing on building wealth over time, not just quick speculation, using the advantages responsibly.
Good point. Okay, so those are the 8 lessons. If we zoom out, what are the big overarching themes we pulled from the 2024 material?
Well, a few things stand out. First, markets look ahead, but they're not psychics, right?
Right.
They get things wrong. And that gap between expectation and reality, that's often where opportunity lies.
All right, good one. What else?
Second, diversification is still vital. But thoughtful diversification, not just owning lots of stuff, but different kinds of stuff. Business models, geographies, company sizes.
Quality matters too, you said.
Paramount. Especially when things feel uncertain. Strong balance sheets, real competitive edges, good management. That's lesson 3.
And fourth?
Flexibility. Being able to adapt. What worked before might not work now. Markets change.
And finally?
Finally, it all has to fit you. Your goals, your timeline, your comfort with risk. Don't chase someone else's strategy if it doesn't suit your own circumstances.
That's really important. So looking forward, do these 2024 themes just fade away?
Probably not entirely. I mean, AI's evolution isn't stopping. Interest rates will surely keep influencing things. Geopolitics isn't going away. And the need for selective stock picking seems likely to stick around too.
So the lessons have some staying power.
I think so. Which leads to maybe a final thought for you, listening.
Okay.
How could you use these lessons from one specific year, 2024, as a kind of a mental model for understanding the market in a year?
Like, the principles are timeless, even if the events change.
Exactly. Think about those core ideas. Business fundamentals matter. Expectations drive prices. Diversification helps manage risk. Quality endures. Understanding those principles, well, that's probably much more valuable in the long run than just remembering what happened in 24.
Become a constant learner from the market itself.
That's the idea. The market's always teaching.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, You agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.